Weekly Economics and Finance. This past week, the S&P 500 saw a decrease of 1.57%. More notable than the drop, however, was the volatility. Following a larger-than-expected Consumer Price Index (CPI) report on Wednesday, the stock indices, which had significantly fallen, rebounded on Thursday after the Producer Price Index (PPI) was reported lower than expected. Yet, on Friday, the stock indices fell sharply again due to the emergence of geopolitical risks between Iran and Israel. It was a rollercoaster week. The market's focus on the possibility of the Federal Reserve cutting interest rates in June has now greatly diminished, with more weight being given to the opinion that the cuts will begin in September and occur only twice this year. The reason for the reduced likelihood of a June rate cut is, once again, due to inflation trends. In this atmosphere, it seems more likely that the European Central Bank, ECB, will enter into rate cuts before the Fed does. There have been concerns that initiating rate cuts before the United States could destabilize exchange rates, among other factors. However, the ECB has emphasized that it will pursue its monetary policy regardless of the Fed's decisions. Christine Lagarde of the ECB said, "A few members felt sufficiently confident on the basis of the limited data that we received in April. It was just a few members and they agreed to rally to the consensus," adding, "We are not Fed-dependent." CPI Blitzkrieg. This week's blitzkrieg of CPI concerns began on Wednesday when the Consumer Price Index (CPI) inflation rate showed continued stickiness, coming in higher than market expectations. This led to a decline in stock prices and a rise in market interest rates on the same day, significantly reducing the likelihood of a Federal Reserve rate cut in June. The year-over-year CPI increase for March was 3.5%, up from 3.2% in February and exceeding the market expectation of 3.4%. This marks the highest figure in 6 months since September last year, which saw a 3.7% increase. The core CPI, which excludes volatile food and energy prices, also rose by 0.4% month-over-month and 3.8% year-over-year, surpassing the market forecasts of 0.3% and 3.7%, respectively. Housing and energy prices, in particular, have been the main contributors. Housing costs, which account for about 1/3 of the CPI weight, increased by 0.4% month-over-month and 5.7% year-over-year. This is attributed to the continuing rise in house prices, though at a slower pace. Though it makes up a smaller portion, one area of note is the car insurance premiums included in transportation services. Despite accounting for less than 3% of the CPI, the increase in car insurance premiums is presumed to be due to rising car repairing labor costs. This is evident from the resurgence in the cost of dining out, food away from home, indicating that it might be time to reevaluate the declining wage growth rate. On Thursday, the number of new unemployment claims slightly decreased, signaling that the labor market remains tight. When the Fed announced February's CPI last month, it mentioned that seasonal adjustments and data collection methods contributed to a slight uptick in the inflation trend. However, March's CPI could serve as a confirmation of inflation stickiness. Until the June FOMC meeting, there will be no new summary of economic projections from the Fed. Thus, the Fed will likely watch a few more rounds of inflation data before providing clear hints about the interest rate cut schedule. The Fed needs to see inflation converging towards the 2% trend line, but for now, inflation is still not making significant progress. The financial markets are expected to remain volatile, depending on how future inflation outcomes differ from market predictions. Neil Kashkari, president of the Minneapolis Federal Reserve, on April 4, said, "If we continue to see inflation moving sideways, then that would make me question whether we needed to do those rate cuts at all." Tame U.S. producer price data soothes inflation concerns. The release of the Producer Price Index, PPI, inflation data, unlike the CPI numbers, was more subdued than market expectations, bringing a sense of relief to the market and a boost to stock prices. The PPI for March rose by only 0.2%, below the anticipated 0.3%. This was a significant moderation from the 0.6% increase observed in February. The core PPI, which excludes volatile food and energy prices, also saw a modest increase of 0.2% month-over-month, slightly down from February's 0.3%. Compared to CPI or PCE inflation measures, PPI inflation is more volatile due to its substantial reflection of the prices of volatile raw materials. Additionally, it includes a smaller proportion of service prices, only incorporating limited areas such as production-related transportation and warehousing costs. At a time when service inflation is becoming increasingly important, it's difficult to attribute more significance to PPI data over CPI or PCE indicators. This is why the bond market showed little reaction to the PPI data. Investors in the stock market tend to believe what they hope for, leading to a premature rise in stock prices. Let's look at the inflation expectations. They does not paint an optimistic picture. Trading in the bond market suggests that traders are betting on a longer duration of inflation than currently anticipated, with expected inflation values on an upward trend since the beginning of March for both the 5-year and 10-year inflation expectations. It is normal for inflation to converge to inflation expectation over time. If inflation expectation is high, inflation will not fall as easily and the Federal Reserve's interest rate cut may be delayed. Why is inflation so persistent? The initial inflation post-pandemic was primarily driven by the release of pent-up demand and supply chain disruptions. However, as we inch closer to achieving the 2% inflation target, other factors are now being considered. The persistent nature of service inflation is due to the income elasticity of service consumption. As incomes rise, there is a greater relative demand for services over goods, which in turn increases their prices. Therefore, service inflation tends to slow down more gradually in a soft landing scenario. Additionally, the level of savings remains an issue. The savings rate, which had spiked to 32% during the pandemic, has dropped to 3.6%. However, the savings accumulated during this period are still substantial. While smaller than pre-pandemic levels, they are not insignificantly small. Consumers still have the capacity to spend. Government policy also plays a role. The Federal Reserve is maintaining high interest rates that could constrain economic activity. However, the government's fiscal policies are contributing to price increases. The federal government is injecting money into the economy through student loan forgiveness, tax cuts, and subsidies related to the Inflation Reduction Act or CHIPS Act, etc. Iran to attack Israel, sooner rather than later. Crude oil prices play a significant role in U.S. inflation. Although not included in core inflation, fluctuations in oil prices can influence core inflation after a few months. Amid heightened sensitivity to inflation in the market, news of imminent retaliation from Iran has had a considerable impact. Recently, international oil prices have remained stable since peaking on April 5. However, an actual attack by Iran would be likely to push these prices significantly higher, if it happens. When news of Iran's potential aggression spread on Friday, the market quickly shifted towards risk-off trading, preferring safer assets. This led to a decrease in stock prices, while bond prices, gold values, and the value of US dollar all increased. Especially in the bond market, after CPI inflation was reported higher than expected, a strong sell-off enveloped 10-year Treasury bonds, causing interest rates to surge. Yet, the sudden increase in geopolitical risks in the Middle East prompted a shift to risk-off tradings, bringing rates back down to around 4.50%. Because it is unclear that what kind of conflict would happen in the Middle East, the interest rates are expected to remain high. The fluctuations in gold prices and the value of US dollar typically move in opposite directions. When the 10-year US Treasury yield approached 5% last October, the value of dollar soared and gold prices plummeted. However, after the Fed's pivot, gold prices have significantly risen, reflecting anticipated rate cuts by the Fed. This rise was further amplified by Chinese investors preferring gold as a safe asset during economic downturns. With the addition of geopolitical risks, the value of gold, along with other safe assets like Treasury bonds and the US dollar, has increased even more in the period of risk-off trading. Earnings season began. The stock market's decline this week was influenced by inflation worries and geopolitical risks from Iran, but there's also a psychological unease ahead of upcoming corporate earnings reports. J.P. Morgan is usually the first to announce its results. Although J.P. Morgan reported better than expected results, it gave a pessimistic outlook for the remainder of the year, disappointing the market. Until now, The argument against the overvaluation of the stock market was that corporate earnings could support stock prices within a soft landing economic cycle. However, if this earnings season fails to meet expectations, market sentiment could shift. Jamie Dimon of J.P. Morgan, in his notes to investors on April 8, stated, "Many economic indicators continue to be favorable. However, looking ahead, we remain alert to a number of significant uncertain forces. First, the global landscape is unsettling. Terrible wars and violence continue to cause suffering, and geopolitical tensions are growing. Second, there seems to be a large number of persistent inflationary pressures, which may likely continue. And finally, we have never truly experienced the full effect of quantitative tightening on this scale." Less for longer. The Fed's March FOMC meeting minutes released this week highlighted discussions about reducing the scale of quantitative tightening. Since peaking at $9 trillion in May 2022, the Fed has been gradually shrinking its balance sheet by allowing the maturity of Treasury and MBS holdings. Currently, it's reducing the balance sheet by $95 billion a month. However, there's concern that continuing at this pace could lead to a credit crunch similar to what happened in 2019. Therefore, several Fed members are advocating for halving the current pace of QT, arguing that this would allow QT to continue for a longer period. The market has not yet reacted seriously to this narrative. While a prolonged QT presents a long-term burden, it's considered a short-term boon for the financial markets.